Hi, it's Abbott, your SMSF guru. I've been in self-managed super funds right from the inception on the 1st of July 1994. If you're obviously in my YouTube, you can see I've got over 300 videos there, so I sort of know what I've done, and I've written 5 books on it. Most importantly, one of the big questions I get and have got for the last 35 or so years is, what is a self-managed super fund? Essentially in Australia in 1992, and that's when I made a shift from tax law to superannuation, was that we introduced the concept of super guarantee, where people would be able to put superannuation, or your employer put superannuation into your superannuation fund. In those days it was very, very backward. Self-managed super funds only just started off, and then 2007, when superannuation to be taken out after age 60 was tax-free, it really started to take off, particularly around self-managed. So what is a self-managed? Well, essentially it is a fund that you set up. Your accountant can set up the self-managed super fund, or we can do it at LY Legal, or like your legal to help you do that. Importantly, you'll need to have a corporate trustee. Why do we do that? It's just simpler because if you have individual trustees, you can't pay out lump sums from that fund. And once you're in there, essentially, you'll find that the fund has to, much like a trust or any other structure, you have to lodge income tax returns each year, get it audited, which isn't an overly expensive process. But once you're in there, you need to make sure that you start to build a lot of strategies, and that's why you want to follow me to keep up to date with every strategy. But you can then start to invest in whatever you like. So you can borrow money to acquire a property, and why wouldn't you do that inside a self-managed rather than outside? You can buy crypto, you can get into gold. A famous one is obviously doing a lot of exchange traded funds, stocks that have imputation credits, and then you can go to your employer. Quite apart from SGC, you can put in a little bit more into super, because it has that compounding effect. When you're up to pre-retirement age, any investment income inside that fund is only taxed at 15%, 10% on capital gains. But once you get to retirement, there's no tax. So I could have had a property in there for like 30 or 40 years that's got a huge capital gain. Once I start retirement, that capital gain disappears, and then I'll be drawing tax-free income. So again, self-managed super fund, have a look whether it's right for you. Go onto my website, grantabbott.com, and then really start to explore. But you know, it's where all the smart money is. One of the big questions I always get asked, and I've always got asked, not only by people who want to set up a fund, but more importantly, even by the regulators. It originally used to be around about $200,000, so that if there's yourself and your spouse, you can have up to 6 members in that fund. Essentially, if you're looking at that, $200,000 is where you want to be. Unless you're obviously 60, 65, $200,000 is pretty light on, because your monies will be starting to dwindle, and the administration cost for a self-managed super fund is probably around about maybe $3,000, $4,000 a year. So you want to be on the right side. But if you're 30, 35, 40, and you've got maybe $140,000, then it could be great for you, because you could use that $140,000. You could then borrow from the bank up to 80%, so you can borrow like $400,000, and then go and get a property worth about $500,000, and keep on piling your contributions in there. And more importantly, from that perspective as well, you're going to be setting yourself up for buying more properties, or buying gold, silver, crypto, whatever you want. It's about taking responsibility. After all, this is your money that's going in. It's your salary and wages are going in there. So what amounts appropriate? It really depends on your age, but have a chat with your accountant, or you can obviously just do a little bit more research. There is no set defined amount, but remember, it's all about pooling resources. And if you want to get a copy of my, book, it's a little bit old now, 2017, 2018. Go and have a look on Amazon under the Grant Abbott. Look for the Guru's Guide to Self-Managed Super Funds. One of the big things, and certainly I always put this in my book, is that there's a whole range of benefits in having a self-managed super fund. First off, you control your investments, as opposed to an industry or retail fund where you're giving up that investment control to that. You can choose investments that you'll never ever be able to find inside a retail industry fund, like residential property you can borrow to invest in, which you can't do in those. You can go to cryptocurrency, gold. You do a whole lot of specific, even like smaller investments, property syndicates, etc. And I've seen a lot of people do really well there. You can manage your taxation, and you have to remember that industry and retail funds have $3 million people, so they've got fairly rigid taxation rules. We've got a lot more flexibility in there. You can get life insurance, TPD for yourself and also your children. You can have up to 6 members, so it becomes a real family superannuation fund. In terms of estate planning, you can build an SMSF will rather than what we call a binding death benefit nomination, which are becoming increasingly litigated. And again, that's something that fits in with the self-managed superannuation fund. You can take pensions, reversionary pensions that go down multi-generations, just like there's so many benefits there. What are the disadvantages? Disadvantages, you've actually got to take an interest in yourself, work out how much time you need to spend on it. Now, if you're going to do a lot of trading, currency trading and all that, well, obviously expect to have your fees quite high. But if you're going to just put the money in with you and your spouse, maybe if you've got your kids as well, put it in there to get a house or a property, set and forget, you're going to be in a pretty good position because there's not that many transactions that go through, which means your administration fees are low, and then you can just keep on putting contributions in, get rent, and that will pay off that property pretty quickly. Generally we always put in place a corporate trustee. That means as directors you also have professional responsibility around the self-managed super fund, make sure it complies with the rules. But there are a lot of tools out there, so you can either read, or more importantly, I've got a program called Strategist AI, so the strategist.ai, and that can help you actually work out exactly what the rules are. Or more importantly, taxguru.ai, that has a system in it that you can actually ask around self-managed super fund questions. So that will cover all your compliance. Can I do this? Can I do that? Can I do something else? So again, it's really take the responsibility. It's important, but there are a lot of benefits that outweigh that responsibility. And remember, it's your money. You want to make sure it grows to $2 to $3 million by the time you're age 65. I just had a meeting with a client who was been overseas for a little while, and they've got an Australian self-managed super fund. It looks as though they're not going to come back to Australia. So they wanted to know what the potential tax consequences were and what needs to happen. Now, there's a whole range of things. There's 2 tax rulings that apply to this, but in essence, if you're a non-tax resident, so resident of, say, France or Italy or anywhere overseas, and you're still running a self-managed super fund in Australia, there's a danger that it'll be treated as a foreign super fund under Section 295 of the Income Tax Assessment Act, which would mean that the total market value of the assets will be taxed at 45%. So that's a pretty hefty penalty, plus administrative penalties on top of that. Now, in terms of that, the key feature is central management and control. So how do we keep central management and control in Australia? Now, there's a couple of things in these rulings. One is that when you are doing the investment strategy of that fund, you do that when you're in Australia. So that's an idea to book in with a financial planner. Just do that so you can still stay offshore. You just got to be very careful. You can't, when you're offshore, you can't make contributions into that fund. That's fair enough. You don't really want to do that. The second one is that you have someone who takes your place as a director of the corporate trustee or the trustee of that self-managed super fund, and they hold your enduring power of attorney. Now, of course, they're going to be making all the decisions around that. But again, it's going to depend on the circumstances and also the facts of your case. Remember, around about 1998, people were buying ostriches in their self-managed superannuation funds because apparently ostrich leather was going to be the big thing in terms of handbags. Not sure, I'm not a handbag aficionado. I've seen people day trade. In 2009, 2010, I changed the SMSF trustee that I had at that time to enable Bitcoin because I saw that Bitcoin was coming in at that time. Imagine if I'd invested in Bitcoin then. And since that time, then when there was NFPs, any digital currencies, I really made sure that the trustee that I had catered for all circumstances. So I've certainly been at the cutting edge of that. One of the areas about self-managed super fund is we have a wide range of potential investments. People have vintage cars. I've had artwork in the past in my self-managed super fund. people have chalets from Italy or France in there. Again, each of these are valid investments. You just got to be careful of them. If you have Bitcoin in that, it's not such a big issue, but you can't really go and have a chalet and then go and stay there, or a holiday house and go and stay there. So again, that's a breach of the rules. But in terms of Bitcoin, just remember it's a volatile investment. All digital assets are volatile investments. So if it's on the way up, it's fantastic because we want to make a profit out of it. I think around about November last year, I was telling everyone that, when it was up around $120,000, it's always a good time to book in a profit for that one. It's a bit underwater, but again, go back and do your charts and have a look. So again, with a self-managed super fund, it's your fund. You just got to be careful using related party assets or using assets for related parties. But essentially, it's up to you to make investment. If you lose a lot of money, well, you lose a lot of money. If you gain a lot of money, then you're going to be a bit of a hero. Anyway, Grant Abbott, grantabbott.com, signing off.